Hello, friends. What if I told you there's a secret way the wealthy store their money, grow it tax free, and borrow against it to buy cars and real estate without ever interacting with a traditional bank? Sounds incredible, right? It's called infinite banking or be your own bank. You've probably seen it pitched all over TikTok and YouTube, financial gurus promising it's the ultimate wealth hack. But there's a dark side they rarely mention. Today, I'm going to rip open the math behind infinite banking, expose the hidden fees, and show you exactly who is actually getting rich off this strategy. Spoiler alert, it's probably not you. Let's start with the basics. What exactly is infinite banking? Despite the fancy name, infinite banking is not an investment account, a magical trust, or a secret offshore bank. At its core, the entire system relies on one specific financial product, a dividend paying whole life insurance policy. The pitch goes like this: you overfund a whole life insurance policy with massive premiums. A portion of that money goes towards the death benefit, but the rest goes into a cash value bucket. This bucket essentially acts like a savings account that supposedly earns a guaranteed dividend. Then, when you need money for a car, vacation, or down payment, you don't pull your money out. Instead, you take a loan from the insurance company using your cash value as collateral. Because you are just borrowing against your policy, your original money is still sitting inside the policy, compounding and earning dividends as if you never touched it. You get the car and your money keeps growing. You are the bank. Sounds perfect, right? Well, let's look at the math the aggressive salespeople don't want you to see. Let's start with the cost of admission. Whole life insurance is outrageously expensive compared to regular term life insurance. For a typical healthy 30-year-old, a $1 million term life policy might cost around $50 a month. The exact same $1 million death benefit in a whole life policy could cost thousands of dollars every single month. Why the massive discrepancy? A huge chunk of that money isn't going into your magical cash value bucket. It's going straight into the pockets of the insurance agent who sold it to you. That's right, the commissions on whole life insurance are astronomical. Agents often take home anywhere from 50 to 100% of your entire first year's premium as a commission. Because of these staggering commissions and administrative fees, your so-called cash value is basically zero for the first few years. You could pump tens of thousands of dollars into this infinite banking setup, and if you needed to collapse the policy in year 2 or 3, you would take an absolute bath. You are starting the race miles behind the starting line. But wait, what about the be your own bank part? When you take a loan against your cash value, you are essentially borrowing from the insurance company using your cash value as collateral. Remember, you have to pay interest on this loan. And guess what? The interest rate the insurance company charges you is often higher than the dividend rate they are paying you on that cash value. Furthermore, many policies practice something called direct recognition. This means that the insurance company actually lowers the dividend rate paid on the portion of your cash value that you have a loan against. The entire sales pitch revolves around uninterrupted compounding, but thanks to direct recognition, that compounding is indeed interrupted the minute you take out a loan. So, what's everyone else doing? The golden rule of personal finance is buy term and invest the difference. If you have $10,000 a year to spend on life insurance, you spend $500 on a term life policy that gives your family massive protection, and you invest the remaining $9,500 directly into low-cost index funds like the S&P 500. Historically, the stock market averages about a 10% annual return before inflation over long periods. After fees and commissions, the internal rate of return on cash value inside a whole life policy usually hovers around 3 to 5%. That spread might not sound massive over a year or two, but stretched over 20 or 30 years, the opportunity cost is devastating. $9,500 invested annually at 8% for 30 years balloons to over $1.1 million, and you have liquid access to it without asking an insurance company for a loan. Putting that same money into a whole life policy, you'd likely end up with half that amount in cash value. All the while, who won? The insurance agent who locked you in. And there is another incredibly frustrating gimmick nobody mentions about whole life variants. When you eventually die, in many types of these policies, your family does not get both the death benefit and the cash value. They just get the death benefit. The insurance company keeps the cash value you spent decades building up. Is it a pure scam? Legally, no. Whole life insurance does have a place, but usually only for the ultra-wealthy. If you have an estate worth tens of millions of dollars and have maxed out every conceivable tax-advantaged account like 401ks, IRAs, and HSAs, whole life can be a vehicle to pass wealth to heirs while offsetting massive estate taxes. In the Canadian corner, things look very similar. Before any Canadian even considers overfunding a whole life policy for the be your own bank strategy, they need to have maxed out their tax-free savings account and their RRSP. TFSA allows completely tax-free growth and tax-free withdrawals with infinitely lower fees and no insurance commissions. It is inherently superior for 99% of people. The psychology behind why smart people fall for this is fascinating. Infinite banking preys on our desire for safety and complexity. It feels sophisticated to say you are your own bank. The guaranteed dividend feels safe in a volatile stock market, but you are paying an exorbitant premium for that illusion of safety. You are sacrificing massive, inevitable wealth accumulation just to avoid market volatility. At the end of the day, an insurance agent selling you an infinite banking strategy is a classic case of confusing a product with a solution. For the vast majority of normal retail investors, blending your life insurance needs with your investment returns creates a Frankenstein product that does neither job well. Keep your insurance out of your investments. Buy cheap, reliable term life insurance to protect your income for your family, and direct the immense savings into a brokerage account buying comprehensive, low-cost index funds. Simplicity and consistency, not expensive gimmicks, are what build true generational wealth. If you avoided a costly mistake today, hit the like button and subscribe for more transparent strategy breakdowns. Let me know in the comments if you've had an agent try to pitch you this setup. Building wealth doesn't require a secret system. As always, this is not financial advice, just educational content to help you think through investing ideas. Always do your own research and consult a qualified financial advisor for your personal situation. I wish you good luck, stay the course, and I'll see you in the next one.